We want to welcome everybody out to the December WASDE meeting. It seems crazy to think it's already December. And it's one of those meetings, Sterling, where we have transitioned already in November, kind of from that unknown number to kind of a post-harvest number when it comes to acreage and yields. But right now, on our pre-meeting conversation, we've really looked at exports and looked at some supplies that are potentially coming out of South America. Sterling, if you had to pick something on this report outside of yields and acreage in the United States, what are the 2 to 3 things we're going to focus on today?
This is the December report. This is the report that comes before the big report in January, which is typically the final report. Normally, we do not see yields and acreage adjusted whatsoever. Production is left alone. The place where we do have a little bit of risk is, do they do something with exports? Now, we've seen a little bit of a pickup in export activity over the last 2 or 3 weeks. Are they going to be willing to change the WASDE numbers on this? Now, some of this is China, and it's great that China is in here buying. That's good news. The thing about China is it's not just if they buy. What is it, Brooks? It's if they actually take it.
Yeah, there you go.
Yeah, they have to come in here and take this. So, the corn export number at 2075, that's going to be, if we could move this back, maybe you could move it back 50 on, they might move it back 50 on this report, maybe 75 in January. That would take a little bit of the edge off. It's not going to be screamingly bullish, okay? But it will take a little bit of the edge off and maybe, at least, get the short covering under control, because the price action we've seen, in the corn market has not been very great. The other one would be, obviously, if we could do something with the soybean export number and see that pushed up, even if we could get this to 1,800, that's 45. That gets us back to 200, which that would, again, be able to spike a little bit of nervousness. The other thing that we need to watch for is, what do they do with Brazilian production for soybeans? CONAB was out yesterday. They took it from 162 down to 160. Now, most street analysts, myself included, moved everything back from Brazil from 162-ish to this 156, 157 area. And some of that is based on administrative behavior within the USDA and how they get that number. The weather has shown some improvement in Brazil and their soybeans. They can bounce back. So we could see a situation where they cut it, and if the weather continues to improve and stabilize in Brazil, they could put that right back in. So that's something that could create some volatility for today. And if they do cut that and it pushes beans higher, that might create some opportunities. But they
Sterling, as you evaluate that corn number, that export number, it's important for everybody to remember that 2.075 billion bushels that we've got out there as an estimate is extremely aggressive. And when we talk about this smidgen of hope we've seen in exports the last 2 to 3 weeks, in my opinion, that might reach the 2.075 billion. To add to that significantly, it's going to take some big safrinha crop problems, and that's something, again, we really won't know where we stand for probably another 70 days to start that. So that 2.075 number, it's very, very unlikely that we go above that. I think right now, if we see aggressive buying, we maintain that number. That's important to know, because that's really outside of a change to acreage or production in the U.S. That's what corn's hopes have to lie on over the next 6 until we get to an acreage situation. And there's a lot of folks in the U.S. already looking at acreage for 2024. A reduction in acres is likely. I think right now around the 92.4 million acre number on corn is really what the industry expects. So we're in the doldrums of this corn market right now, and it's going to be tough to find anything fundamentally in corn in the next 60 days to really power that market forward.
And there are a couple other things that we need to think about here with corn. Gasoline demand has not been that great. It has not really improved. In fact, we're running below the 5-year average, which should be 2019 through the pandemic. So that 5-year average now is more weighted for having more people working from home than driving to work. The fact that that hasn't improved could mean a little bit of a problem, or it certainly won't allow for any growth in ethanol, put it that way.
You know, that's
Be a little
interesting
downside.
that you bring that gasoline consumption up. Pre-pandemic, and I'm going to go to the 2018 numbers. We were using 30 billion plus gallons of gasoline for highway usage in the United States. After the pandemic, that number dropped closer to 20 billion. That's a huge drop when you think about that.
Yeah.
A big drop, and it's never recovered. Sterling, is it too soon to say it will never reach that 32, 33 billion gallon number again? Or have we changed our ways enough?
We have changed our ways a little bit, but there's some other things to think about too. We had pre-pandemic, we had a lot of older vehicles on the road. That was 2019. That's going to be 5 years ago. Okay. So we have a lot more newer vehicles on the road. Newer vehicles use less gas inherently. As the car gets older, it's going to use more gas, and new ones are more efficient than old ones. That's a structural change. EVs, well, they're going to make a little bit of a ding and a dent here and there. That's another problem. Then we have fewer people driving to work, and then we have the young person problem, which creates two problems for our commodity markets. They don't like to drive. That's the first problem. And since they're not driving, they don't buy any clothes. They sit at home in their sweats. They don't go out and go to the Gap and buy things, which is creating a demand problem for cotton as well. Now, maybe this behavior will change, maybe it won't, but that's something where we have these new structural difficulties. And cars, yes, they're going to be more efficient. Toyota is wagering heavily on this, that we're going to see a lot more hybrids, meaning you're not all electric, but you have a hybrid that, buzzes around sub 30 miles an hour in town on an electric engine, then it'll self-recharge its battery when you're on the highway. That's a very middling solution to this all-electric thing that Toyota thinks is going to be the real wave of the future, how things happen, because I think they believe that California is not going to be able to go all electric in 2030. I think that's what their thinking is those laws are going to have to be changed. But again, if you have a hybrid, most of the gas you use is when you're taking that vehicle from 0 to 30 miles an hour. When you're rolling down the highway, your mileage is a lot better. When you do that with an electric motor, well, that's inherently less gas you're going to use right at the margin, which in turn pressures everything else back. So that's my lecture on energy today.
Not a lot of hope in that statement, but that's where we're at.
Well, reality is a bus.
It is, yeah, that's right.
Acknowledge it coming, or you may suffer very painful consequences other than what hope might want you to reach to. So that's a structural change. We are not going to get around that.
So let's talk about something that we can maybe fundamentally hope in this report, and it's that ending stocks number on soybeans at 245. Sterling, what's the lowest that number could be cut to today in your mind?
The lowest that number could be cut to, we could add 15 to exports, and that could cut it to 230. Again, this is the December report. When I put in my guesstimates, I left everything unchanged. That has been the USDA's track record. So if we do get a change in a surprise, we could get a bit of an outsized move in the market. That's the one thing that we do need to kind of think about. And if we take a look here, let's pull up some charts here. Let's look at soybeans. You can see our soybeans have had some wiggle and some waggle. We had our little weather bump here, but now we're starting to find at least a little bit of support. and the prices came down a little bit, and that is helping the export market. This number right here, this is January. This is $13 a bushel. That is the new line in the sand. We must hold that. If not, we're going to invite some sellers. We do have the oscillators, actually kind of bullish here. This is giving a buy signal, and we bounced off oversold. So that is favorable, and we're trying to climb up back up through the moving averages. That gives us maybe a high target. Could we get to 14? Maybe. Could we get to the neighborhood of 14? Yes. And without a fundamental change, those are prices that are probably going to attract some sellers.
Sterling, I'll play off that and talk a little bit about the cash market. At that $14 level, and I know the basis levels have fluctuated and maybe cooled off a little bit from where they were at 60 days ago. There's a lot of reasons for that. But if we see that $14 cash level, which is a long way away, it's probably 50 to 55 cents on the board away from being able to achieve that in the southern part of the United States. That looks to me like a good place to turn crop into cash. A lot of farmers meeting with accountants right now, they're making those prepays. If they have to have last minute cash, it certainly seems like soybeans are the commodity to be dealt with right now. I would really love to see it, Sterling, if we could get that board up another 40, 50 cents and allow some sales that put them close to profitability. In a lot of places in the country, that's a profitable number.
Yeah, that would be very good, especially if you can do it without having any basis pressure. Now, if we look at export inspections, last week and over the last 3 weeks for soybeans, they've fallen out of bed because we do have some export problems. But on the other hand, we saw some very good purchases of soybean meal. So perhaps we can get the crusher a little bit enthused if we can get soybean oil prices back up, which is a possibility, along with soybean meal prices. Problem with the soybean oil has been crude oil, and that's fallen completely out of bed. But we're seeing some buying come in here. I think, when we're trading sub $70, that becomes kind of a problem. We saw very good volume buying gasoline futures right around $2 a gallon, and we bounced off that nicely. If we can see energy prices move back up, that will drag the soybean oil kicking and screaming higher, and that will improve crush margins, because right now, March crush is only 102.75. We look, nearby crush is nearly twice that. So if we can see crush improve, that can give a little room to work on basis, and we can see things improve. So we need some other commodity markets to come in here and help us out a bit.
One thing that's absent from our conversation really over the last 2 or 3 months that we've done this, Sterling, I know we're really close to release. We may actually have a release there on one piece of data, but
no, we're 51 seconds away.
We haven't talked about that, the political situation globally. It seems like the things like Ukraine, even Israel Hamas situation have kind of faded a little bit as an impact on these markets. You think that's going to be a trend? It seems like when we go to sleep on those things, that's whenever we wake up. But certainly seems like we haven't focused on those as much as we were 3-4 months ago.
That has moved away from the market, but we have a new problem, and we're going to talk about this right after the report. And this is a problem in South America. This is something that we haven't really ever experienced, and we're going to talk about what's going on with Venezuela, Guyana, and Brazil. But it's 11 o'clock, and we should be getting some numbers here. Corn ending stocks at 2.131. That is actually a cut. They did push up those corn exports.
Good.
Up 25. That is a little bit of a surprise. Soybean exports 1755. Soybean ending stocks sharply unchanged. So they did nothing there. And let's see what we have for wheat ending stocks. 659. They actually cut those. Wheat exports, they pushed those up 25. So we did see a little bit of a surprise here in that those flash sales did make their way into the WASDE, which is a little bit unusual. Now let's see here. We've got corn ending stocks down a bit. Did that help the corn market? Yeah, well, we're up 2 here. Let me make a very quick chart of this. Hey, we're up 2.
Hey,
Hey,
we'll take it. We'll take it.
Folks, we're in that game where a dime bounce is a dime bounce, and we need to take it. So here with corn, as you can see, coming into the report, we have managed a little bit of a bounce, but basically no big surprises on the day. We'll see. The wheat market has been a little bit better here. We're trying our best, and there's big short positions in Kansas City and Minneapolis. We can drag the wheat market higher than the wheat. Coming into the report, we were down a little bit on the day, but we did get a little bit of a bounce there. And with the soybeans, the soybeans were up 8, 9 when we started the report, and they're still up 8 or 9. So let's go back here. Let's take
Sterling,
a look.
was there a report today that I missed because the market doesn't act like it?
Well, there was a report today here on the soybean production for Brazil. We went from 163 to 161, so everybody missed that. Corn production for Brazil, let's see here, corn production, 129. Now, this number is 10 million tons higher than the South American estimates coming out of CONAB. So they've taken a noticeable bit off that. The USDA is not complying with that, though. Argentina for soybean production at 48, still the same. And notice last year it was 25. This year it's going to be 48. That's 23 million tons of soybeans, folks. That matters. And then here, if we look at corn production unchanged at 55, that's up 21 million tons of corn. Now, we were talking about the politics. There has been a buildup of Brazilian troops on the border between Venezuela and Guyana. There is a dispute over ocean territory between Venezuela and Guyana, which we're talking about Guyana, but there is a big splotch of oil, like 11 billion barrels, or just some huge amount of oil that is currently land that is owned and claimed by Guyana that Venezuela wants. Now, military action down there, Guyana is a jungle. And there is one road that leads into Guyana from Venezuela, and it goes through Brazil. So far, this has only been kind of fringe stuff. But if this becomes a problem, how is China going to feel about this? How is the rest of the world going to react to this? And this could maybe create a little bit of risk premium in the market. It's not anywhere near any Brazil export ports or anything like that, but that could make the market a little bit nervous.
Interesting.
So,
Sterling, as we look at this, one thing we talk about is the change in corn production, no change in corn production in South America on this report. We'll probably see that materialize first in exports out of the U.S. It's going to be one of those things that we're probably not going to wait for that posted number to be confirmed. We'll probably start to see that in exports out of the United States, and then see that number decline perhaps over the next 60 to 90 days. I think that's going to be our indicator to know that there are some problems out there.
Yeah, and that's one thing. Now, moving back to the Middle East situation, seeing the price of oil drop when there is military action in the Middle East is not normal. I mean, it could have gone sideways, but seeing the drop, there's been a lot of talk about this. U.S. crude production, by the way, is back to pre-pandemic highs. We are moving about as much oil as we can. And this is mixing with lower gasoline demand. But we're seeing generally gasoline demand also in China back up a little bit. And that may indicate that we may be seeing a slowing economy globally, which is something that actually in this, I'm going to take the counter argument here. If China's economy slows, that could be bullish for U.S. grain exports. And here's why. China is a command economy. They don't think like we do. They do not operate like we do. But one thing, they want to keep the populace happy. And if you keep people happy, one, by making sure they're all well fed. And China's food infrastructure isn't ours. So if China begins to feel a little bit uncomfortable about the state of the economy, they might be willing to ramp up hog production. And we're already seeing the inklings of that That's something where we could see China come back in here and start purchasing more corn. We've seen a little bit of it with the cotton market. This is something that where the rest of the world may be having a bit of a problem, this could potentially change things a little bit as China wants to keep their population happy.
I think that's a really interesting point. And you kind of feel like that could happen right now. This is like that we're setting the stage for that to happen. So we'll keep our fingers crossed.
Yeah.
Well, the report, if you boil that thing down, I think there's probably more bullish sentiment in it than there is bearishness, but the market is yawning at today, which is not to be unexpected.
No, I mean, fortunately, there was no new fresh bearish news. That is the good news. We did, in fact, find ourselves with at least a little bit with the corn. Now, even if we increase corn exports 100 million, it leaves the country, we're still going to have a burdensome number. That is not going to change that much. But at least it takes some of the edge off the selling and can abate the selling. We need the soybeans to do that, and who knows, maybe it is the wheat, the beleaguered, bludgeoned, terrible wheat that will lead us out of here. And again, we're seeing China coming in here and buying a lot of wheat. They're doing that, one, because I think they want to keep food prices down, and they've managed to do that with pork. Pork is down 10 cents a pound over the last 2 weeks or so. They also may have some fears about Brazilian wheat that they're importing. So there may be some concerns there, and that may help. It's not going to create a raging bull, folks, okay? But it can at least, contain the bear.
Sterling, looking at these charts you got up there, it sounds crazy, but we're going to start some projected pricing periods here in about 41 days in the United States. And that December corn number at 515, pales in comparison to where we were at last year. And the one thing that's going to be very, very important is we need some type of boost, before that January 15th and February 1 start dates for those discovery periods. It would certainly be nice if I could put something on my wish list. I would love to see December corn somewhere closer to 550 than $5 when that time period comes. And I probably can't emphasize this enough. And I think it's for everybody to go out and spread this news. Most of us on this call are from small towns scattered across the U.S. And that market in February is so vitally important, not just to the farmer's business, but to our rural economies. Whenever you've got a county that agriculture is its foundation, that number in and of itself, with the guaranteed dollars that come back in to the auto parts stores, the equipment dealers, the mom and pop repair shops that are out there, it's a big, big deal. So, Sterling, we need to get this market jump started soon.
Okay, this is a chart of December corn. This is new crop corn. I don't hate this chart. We've been sideways for a long time. We've had a lot of consolidation. Again, people are going to start cooking up their acreage ideas, probably after they eat lunch after this report. We are likely going to see corn acres migrate into soybeans. I think that's kind of an inevitability. If we get that, that is something that can at least help us boost. And right now we're at 512. Did we put 30 cents in this market? Possibly. If we get a little help from the front end, that would help. A little help from the beans, that would help too. Moreover, the fund position and the way their position is constructed against that big short wheat position, if we squeeze the wheat market, we can squeeze the front end of the corn market. It doesn't make any sense fundamentally, but when we look at positioning and how waves and cycles work, that does create some potential here for you. There is the potential, but we're going to need some help. A little dryness in Brazil wouldn't hurt. So there is some possibilities here as this market has managed to hold up fairly well. When we talk about cycles, though, there's something else I want to talk about, and this is not good news. This is a chart of the 10-year Treasury yield. And I'm not a big fan of Elliott Wave. I think it works perfectly in hindsight, but it works perfectly in hindsight, does mean something. Right here, as you can see, we had this big run up in 10-year rates, and the stock market got all funky and mortgages went through the roof. This move launched from a rate of 410. We went up to 5. We printed 5 at 2 in the morning. Yesterday, we traded down and challenged that 410 level. We were right in front of a big unemployment number, so that market was pretty dry. We got the unemployment report today, and notice we are higher, meaningfully higher, 10 basis points, and we're 15 off the lows. This could indicate that this down cycle is over and we're coming back into a cycle of higher rates, which would correspond to a normalizing yield curve. If this does in fact happen, and this is no way confirmed, we have CPI numbers next week and we have Jay Powell speaking. But if this cycle and the yield curve tries to normalize, that could be bullish for the dollar. That might create a little bit of a headwind, but kind of like the situation in Ukraine, we've kind of been ignoring it. So China does want to improve their relations with us. And if they need to feed the people, this is something that could be, we could whitewash that and see some support come in. But the prospect of interest rates going back up after this really nice decline we've had is very real.
Yeah, I think we've done a pretty good job illustrating today, Sterling, the things that seem most likely to occur in the market are generally not that shock the market and make it a mover. And I think you pointed to two things that a lot of people, it may be off the radar, but the last slide you put up is key. Also, the little situation in South America is not something to be taken lightly. Any conflict down there, maybe it's unlikely, but the threat in and of itself.
We lost you, Brooks. Can you repeat yourself?
Security's out.
Can't hear you.
Are you there now?
We're there now. You're here now.
Yeah. No, I just pointed out, the things that we don't see are the ones that typically can bring us good things. And I think you did a good job pointing out the two that are not obvious fundamentals in the market, but that could certainly be there.
Well, I try to look under every rock, and we have had markets that have not behaved as we would expect. Normally, we would expect these interest rates to be higher. We would have expected the energy market to bounce. The fact that they didn't says that there's something else going on underneath the surface. And while we're a data-driven world, our data doesn't get to us necessarily as quickly as we'd like. And that's been particularly true of the cattle market. Grocery retailers have zero pricing power. They cannot raise the price of beef. In fact, it's come down. And this is why we've seen the cattle market just crater. Packers right now, normally the 2015 to 2019 average profit per cow that Tyson slaughters, or the slaughter profit, is $100 a head. We've been negative anywhere from, on a good day, $17 negative to on a bad day, $67 negative for months. And this is what finally forced the cattle market, forced prices lower. And you can't hold on those cattle forever. We're also seeing a big seasonal dip in hog prices. Hog market internals are not that strong. And this gives us a real clear look into the consumer on a daily basis, meaning they're not willing to pay up for protein, even with gasoline prices coming down noticeably. So there's a lot of shifting sand here that could shift in some ways that we may have to look at ways to take advantage of.
Sterling, I'll tiptoe around this subject here for our viewers, but about a week ago to 10 days ago, there was some rumors that hedging of LRP products led to a more extreme sell-off in cattle and hog futures. And I want you to kind of wrap your mind around this. Remember how this would work. As an insurance company, claims are paid based on a price sell-off. So as a hedger, of these products, whether you hedge internally as that insurance company or sell that off to a reinsurance company. You're taking a position to benefit when the market goes down.
Right.
And so that those fit in the event claims are triggered. So essentially, there's no covering of a position if a market goes lower, if that company has prescribed to a very regimented hedge program. Now, if they are on the other side of it, it's obviously some speculation involved, which would not be a responsible hedge. But those rumors that were out there about insurance companies, providing more fuel to the fire on the downside, I would really, really, really look at that with a discerning eye and really understand how they would hedge that. Very, very unlikely that was the case.
I was on a 2-hour phone call with some friends in Germany and with Wade and Drew yesterday, actually discussing this very subject. And there are a lot of drivers within the cattle market. Now, one of my cash cattle sources seems to think that it might have been not so much insurance companies, but it might have been the government. Now, one way we can figure this out pretty quickly when we see the commitment traders report, if we've seen funds do a big job of dumping cattle positions, that's most of it, okay? And the fact that we've had, a shift away from where deliverable cattle were trading at 177, now they're trading at 171. Guess what? Pie in the face in the futures market. So there's a lot of dynamics that go on here. And frankly, these are futures markets, and it takes a lot of muscle to move these things. Okay, it really does. So this is something further information is going to be needed to really discern and figure out exactly what was behind this. But we saw cash prices in cattle move decidedly lower for strong fundamental reasons. Meaning, if you're a packer, you cannot afford to lose $40 a cow. Okay, it just doesn't work when you're used to making 100. Wall Street gets very mad about that.
But Sterling, we got a question that's coming in, and I'll invite Ryan to go ahead and type that in the chat if he would like. Time does permit. We've got some time on our hands. So Ryan, if you've got that question, shoot it out there, and we'll do our best to get you an answer.
And if you could just read that to me, I have sharing issues and things going on with what I can actually see.
When it comes through, I will certainly do that.
So
I did have one text question. I think we answered it though, and it was there's Ryan's question. What do you think beans will do in the future? And Ryan wasn't on for all of our call. The beginning, we kind of recap that very quickly.
yeah.
So obviously we think there is some opportunity in beans.
Yes.
No changes today on the fundamental numbers. That carry out number at 245. But if we are bullish a commodity, it's over the next 30 to 60 days, it's certainly soybeans. And we're going to have a marketing meeting in 2 weeks, and that 2 weeks, it's going to be amazing how the market discerns the weather and the crop in Brazil. We're going to have a lot better ideas, but we believe there are some opportunities in beans. That carry out is just extremely low. There are some weather problems that have already established themselves since day one. We like the next 60 to 70 days. It may not be one of those sustaining markets that runs up, and that's what we've got to be careful of. It may be a market that pops 2 or 3 days. And one thing Sterling's done a good job with the past is really looking at that RSI number, and we're targeting somewhere in that 1365, 1370 January futures level. That looks good. But if you look at that RSI at 60, it's identified some really, really good times when to pull the trigger. And I like that. I like that indicator probably as well as any. That's the relative strength index. Sterling, you want to add some color to that?
And one thing here, and we're looking at the soybean chart right now, we've bounced off of this. The stochastic is giving us a buy signal. As you can see, when this happened before, we got this nice little run up. This one lasted about 3 weeks. This next one probably won't have the same half-life, meaning we'll get right up in here and the market will look, and if we can't take out new highs, we don't have some weather problems in Brazil or a meaningful improvement in crush margins, most likely that's going to be the spot where people are going to start to sell. So again, head on swivels, need to pay attention to this because again, here are these opportunities at these best prices lasted about 3 days here and they lasted 2 days here. I would not expect them to be, anything extended unless we see crude oil really moving up north and north of $80 a barrel.
Well, Sterling, we could go on and on, as everybody knows, but we have been on for a little over 30 minutes, and we appreciate everyone's attendance. Any words of advice that we haven't given as we end the call?
Listen to the podcasts twice a day. Make sure to read the daily stuff every day.
Thursday, right? Right, Sterling?
Oh, you read them every day. And because we are in a volatile period here for a lot of things, and not just the grain prices will actually probably be one of the tamer things, but things like, if you need to lock in, interest rates, your window of opportunity
Watch.
has
Yes,
been opened.
for certain.
It may be closing and it may close rather quickly. That's one thing to pay attention to. Also, locking in energy. Prices are down. It isn't a bear market, but if this thing reverses, it'll reverse in a hurry. And if I told you, when crude was pushing $90 a barrel, hey, you can lock your stuff in, with crude at 70, you thought it was a good idea. So lock in some at 70 because it may not go to 66. Okay. So we may be trying to get cute in here with that. Could end up being an exercise of picking nickels up in front of the steamroller.
Good words of wisdom to follow. We appreciate everybody's attention today. And don't forget, we've got that. We'll see you on the first day of winter, right? I think that's December 21st, first day of winter, as well as an ASDE Edge marketing meeting. That one's going to be a big one. I just have this feeling there's going to be some great information in that right before Christmas. So we will see you on December 21st.
Remember, December 21st is the winter solstice. That is the darkest day of the year. So Brooks and I are going to bring you some sunlight.
We're going to bring you some sunlight for sure and some great sweaters. So we'll see you then.
See ya. Thank you. Have a good weekend.